Hello everyone, this is Ricey and welcome to my channel, The Quest for Wealth. This is the third bank in our series of Canadian banks stock analysis. In this video, we will evaluate the third biggest bank in Canada, the Bank of Nova Scotia. This video is divided into three parts. First part is to establish the company background and operations. Second part is to discuss the financial health of the company and determine its key financial ratios. And the third part is to evaluate if the current price per stock of Bank of Nova Scotia is worth investing on. ScotiaBank is the most international of all the Canadian banks, meaning it has the most branches and office locations internationally. These are all the global operations of Nova Scotia Bank. Bank of Nova Scotia is the third largest bank in Canada by total assets. So going back, Toronto Dominion Bank is the largest bank in Canada in terms of total assets. The second one is Royal Bank of Canada, and the third is the Bank of Nova Scotia. Currently, the market capitalization of Nova Scotia Bank sits at $76.9 billion. We are now here at the financial statements of the Bank of Nova Scotia from 2013 until 2020, and we are at the income statement of the company. Looking from 2020, we can see here, rightfully so, that the company's revenues growing is not as aggressive as what we have seen at TD Bank and Royal Bank of Canada. Nevertheless, there is growth. Looking at the net income is also growing. Now, I have taken these details and put here. So from 2015 until 2020, this is the revenue, this top line, and the net income, which is the bottom, is here. From 2015, it was at 22%, and then it went down to 20%, 22% in 2017, 2018, and 2019 were somehow good performances. But really, on average, from 2015 until 2020, the company performed at an average of 20%. Now, there is a little bit of a question here in 2020 because they were absolutely gone, almost 7% since 5 years ago to 15% net income as compared to revenue. And this is mainly because the company had a high allocation on debt default because of the pandemic. Nevertheless, 20% average net income in the last 5 years is not so bad. Earnings per share of the company from 2015 until 2020, what we see here is that they started at 4.51 and then moved up the ladder until 2017. And then from 2018 until 2020, the company has been consistently depleting its value on earnings per share. And well, this is not a good omen here. This is absolutely questionable. The fact that the company is increasing its revenue, it is also increasing its net income somehow, but the earnings per share is depleting. This is a truly questionable scenario here. Again, in the balance sheet, what we want to see is the total assets to be higher than total liabilities, and we want the shareholder equity to increase year on year. Here, for the total assets of the company, from 2010 until 2014, that's a good 4 years of performance, but then it started depleting for the next 2 years and again moved up the ladder from 2017 until 2020. So 2020 is essentially the highest recorded data. So what we want to see is that the total liabilities to be lower, substantially lower than the total assets. Potentially what we want to see is the ratio of 2 to 1, wherein the company have got $2 worth of assets versus $1 worth of liabilities. Although in the balance sheet here, what we see is that the company has got higher assets than liabilities, but we do not see that ratio of 2 to 1. This is more 1 to 1 or 1.5 to 1. The good thing about it is that the company has got higher total assets than total liabilities. In a while, we will better see the debt situation of the company. The shareholder equity of the company has been, in general, I would say, increasing or improving except for 2014. If you have a look here, it's 45 billion, and then it went down, and then it almost stayed at the same pace in 2015 and 2016, and in 2020 they recorded the highest shareholder equity in the last 10 years. Shareholder equity again is total assets minus total liabilities equals the shareholder equity, and this is the ownership of the investors in the company. Let us now go to the cash flow statement. Here in the cash flow statement, what we want to see here is that the cash flow from the operating activities to be substantially higher than the net income. Going back to 2012, for example, it has been continuously higher except for 2014 and in 2019. This is something that is absolutely questionable here because the company lost minus 9 billion, but it went up tremendously in 2020. The operating activities cash flow was, whoa, 7-8 times bigger than the net income. Looking at the cash flow from investing activities, we have seen the cash flow from investing activities of the Royal Bank of Canada and TD Bank, and none of them actually was able to record continuous positive income from this cash flow from investing activities. And this is much the same as the Bank of Nova Scotia. Not to say that it becomes acceptable that these figures are all negative, meaning the company is just consistently losing money. But the point is that all the three huge banks are of the same trajectory. All of them were losing money from investing activities. And actually, with regards to financial activities, these are the debt that the company takes on. It pretty much is. Actually, if you have a look here, they take, it seems that they take less debt than TD Bank and Royal Bank of Canada. So again, the net cash flow that we wanted to see is positive. Hopefully, 2013, BNS recorded negative cash flow here. In 2014 until 2020 was the time that they were able to record positive cash flow. It is a little bit choppy, really. If you have a look here, in 2014, it was a 347 million. Then it jumped almost double in 2015, and then down to less than 100 million in 2016, and then jumped 7 times in 2017, and just increased from then on. And then in 2020 is much lower than 2019. Quite obviously, there is no consistency of either growth in the company, and therefore we have to have a better look on the various key ratios of this company. The debt to equity ratio, again, is the amount of equity the company uses as compared to debt. So what we wanted to see is 2 and below. And here, the debt to equity ratio is almost hovering at 3. What's risky here is that 2012, it was only at 1.6, and 2013, it was 1.7, and then 1.9, and it's just growing. In 2020, they almost reached 3. And if they do this trajectory for the rest of the fiscal year 2021, by the year end 2021, you can only expect that this could reach or breach 3 already, and their debt to equity ratio is almost the same as Royal Bank of Canada, although Royal Bank of Canada is much bigger than BNS, but their debt to equity ratio is almost the same. The debt to equity ratio of TD Bank is better than BNS. We are at the PE ratio of Bank of Nova Scotia. Back in 2009, the PE ratio of BNS was only at 9.64, and right now, much the same as RBC and TD Bank, they are in their highest PE ratio ever. So with BNS, it is at 13.13, meaning the price of the stock per share of BNS is 13.13 times higher than its earnings. Again, that's still within the average acceptable PE ratio, which is at 15. Nevertheless, I mean, at 13.13, it's much overvalued than TD Bank, and TD Bank is bigger than BNS. So that becomes quite questionable there. Let us now have a look last 11-year growth rate of BNS and looking from 2010 fiscal year October until year ended 2019, there had been continuous and consistent growth in their book value per share. The book value per share of BNS is this is a good number. What we want to see here is that the book value per share to be higher than the stock price per share or the same level. So October 2020, it was at 56.08 book value per share. And right now, BNS is trading at $62.44 per share. And that is a very close call. And that's an absolutely good number there. Now, the earnings per share is the net income of the company divided by all the outstanding shares available in the market. And this is where it becomes questionable because in October 2020, it's only sitting at 5.58. Nevertheless, this is really better than TD Bank when it comes to earnings per share. The return on equity, Royal Bank of Canada's percentage growth is better than this, but BNS ROE percentage is better than TD Bank. If you have a look there, from 2019 and 2020, they were actually depleting their ROIC, whereas with TD Bank and Royal Bank of Canada, it was just growing. The debt of BNS is equivalent to more than 10 years of its earnings. To me personally, I will not invest in a company where the debt is more than 5 years than its earning. We will compare the revenue and other financials of these three different companies. Right now, we are at the revenue of Bank of Nova Scotia, TD Bank, and Royal Bank of Canada. In the year ended 2020, Royal Bank of Canada, TD came in second, and BNS came in third as the highest revenue. But what's exciting, if you have a look here, is that net income of TD Bank and the Royal Bank of Canada is absolutely close already. But if you consider the revenue of RY is absolutely higher than TD Bank. And the BNS is way down below. When it comes to managing expenses and liabilities, TD Bank is absolutely at the top of the trend there. Although their revenue is lower than RY, their net income is almost at par. It's absolutely almost the same as Royal Bank of Canada. And this actually reflects as well with the total assets of the company because TD Bank has got much bigger assets than Royal Bank of Canada. And it is still growing. The trajectory of the growth of the total assets of the company of TD Bank is growing. The cost of goods sold here back in quarter four of 2019, this is where they were sitting at. It's just remarkable how TD Bank is performing with managing its expenses. It is way down below. It's even lower than BNS. And BNS has got lower revenue than TD Bank. We are now here at the total liabilities and shareholder equity. What's exciting, if you will look here, in 2016, Royal Bank of Canada had a higher shareholders equity as compared to the other two banks. But come quarter first of 2017, TD Bank already had a higher shareholders equity compared to Royal Bank of Canada and BNS. And TD Bank has been doing a great job there. And in Q3 of 2020, TD Bank is absolutely at the top of the pack there. And as of Q2 2021, TD Bank really is the head of the pack there with the highest shareholder equity, therefore the highest ownership of the shareholders in the company. This is majorly because TD Bank is really aggressive and spectacular with their management of expenses and debt. Now, comparing these three businesses within their PE ratio by Q2 2021, TD Bank is really the head of the pack. TD Bank has grown tremendously. If we compare the growth of these three companies, TD Bank is doing it the best way, managing its debt the best way, and managing its assets the best way. I will not be surprised if in the future, in the next 10 years, TD Bank will definitely overcome Royal Bank of Canada. TD Bank is worth more to invest on than Royal Bank of Canada and Bank of Nova Scotia. So there you go. Thank you very much indeed